It is easy to show why the after-tax WACC lacks any tax shield using TIP's concept, where TIP stands for the invisible partner, meaning the government through its income tax. Given an original cash flow and its TIP WACC or total WACC equal to W, an infinite number of virtual cash flows may be defined, all of them associated with the original one if the same W is preserved. The pizza size in the following figures may represent the total firm's capital, also kept constant, or TIP's WACC equals W, which is made invariant. The capital composition for the original cash flow is made of stock and debt, since TIP's capital is negligible. The capital composition for the boundary virtual cash flow associated with the after-tax WACC is made of 100% stock since TIP's capital is negligible. The capital composition for the boundary virtual cash flow associated with the before-tax WACC is made of 100% debt. In the original cash flow, TIP's WACC is composed of the weighted cost of capital of stock, debt, and TIP. Note that although the invisible partner has a negligible equity stake in the company, its rate of return is enormous. However, TIP's weighted cost is simply equal to the income tax rate applied to pre-tax profit. Note that the vanilla WACC is the sum of the weighted stock return and the weighted debt interest rates. In this case, the firm's capital is 100% stock with no debt. Consequently, the rate of return to the stockholders is equal to the after-tax WACC. That is just a part of TIP's WACC, the other part is the associated income tax to the invisible partner. As there is no debt capital, there is no tax shield associated with it. In this case, the firm's capital is 100% debt with no stock. Consequently, the rate of return to the debt holders is equal to the before-tax WACC, which is equivalent to TIP's WACC. Observe that, since there is no stock capital, there is no return to the stockholders, so neither tax to TIP. Use only the true WACC, TIP's WACC. The vanilla and the after-tax WACCs are just part of TIP's WACC, lacking TIP's taxes. Although the before-tax WACC is equivalent to TIP's WACC, it represents just a boundary virtual cash flow with 100% debt capital, while TIP's WACC represents the original and all its associated virtual cash flows. Note that both the after-tax WACC and the before-tax WACC have gearing totally diverse from that of the original WACC. Discover how to calculate the debt and/or the tax effect on the rate of return to the stockholders and many other groundbreaking suggestions in finance in this preprint reference.